What is it that you made of the RBI minutes? Do you think they were more hawkish versus a rather relatively dovish tone that the RBI policy commentary had?
I think that would be an understatement.
Yeah.
Given that vast majority of the MPC members actually had views which were quite in contradiction to the language and the tone of the monetary policy review. And I think that, we were probably more surprised by the policy review than by the minutes of the MPC meeting.
No, I completely agree with you. But Jahangir, so how do you, while they have said that they may shift their stance to a withdrawal of accommodation by next June, do you think that that's also, just a broad timeline that they've laid out to prepare the markets? If inflation does edge higher more than anticipated, then they could move faster.
Look, that's always a possibility. That in the event that inflation surprises you very strongly. But, if you're a true inflation targeter, you are not that much concerned about what's happened to inflation today or what happened to inflation yesterday. What you're really concerned about is where your inflation target is 12 months ahead and what you expect to happen between now and the next 12 months. And, you act on that basis. Are you acting too late and you'll have to act too aggressively if you act too late, or do you want to act early enough so that you avoid the possibility of having to aggressively tighten much closer down the road? So, it is possible that they can, act more aggressively before June. But I would think that given where oil prices are, where external conditions are taking, unless something really surprising happens, my guess is that the RBI will probably take it, much more steadily, and I don't think they're going to surprise us. I mean, these could be my famous last words, but I don't think they'll surprise us by acting more aggressively before that.
Jahangir, why such a pull on the money markets? The bond yields have risen considerably. They're at a 4-week high. The rupee is at 30-month low. We're already past 66. Besides the concern on rising oil prices, what is leading to these moves?
Look, I mean, these were, if you looked at the macroeconomic dynamics I would say since September last year, the macroeconomic dynamics were all going in the wrong direction. We knew that the fiscal deficit was going to be higher. We knew that the pressures on the current account would be worse. So when an economy goes through these kinds of fundamental shifts where the fiscal deficit becomes wider, the current account deficit becomes wider, and the pressures are on that direction, not in the opposite direction, then you can use, things like, extending forbearance, which is what the regulatory forbearance, which is what the RBI did, or you can play around with the debt management and, how you're going to plan out your first and second half of the year's debt issuance, etc., to sort of allay the market momentarily. But it is very hard to fight against, a fundamental shift that is taking place in India, and which is what we are saying. That both the fiscal deficit at the center plus state level is widening reasonably sharply, and the current account is heading towards a much wider current account that we have seen over the last 2 years.
So let's put this into perspective, Jahangir. Do you think that with the yields edging higher, especially the treasury yield now going past 2.9%, that we are signaling to the markets that there would be a fair amount of volatility coming in from the macro side, where rising inflation, rising commodity price, led by commodity prices, may lead to tightening of liquidity conditions, thereby, in a way, if not stalling, but slowing down the growth revival that everybody had priced in?
Look, I mean, I think there are way too many variables we're throwing at this point in time. I think, if you look at growth performance of India over the last 4 or 5 years, say, let's say 4 years, I think people attribute that to a lot of various factors, but the only real driver of growth in India has unfortunately been oil prices. When oil prices fell from 110 down to 25, 30, and then rose up, and if you look at the trajectory of India's growth, that's more or less what it has tracked. So, I'm not discounting all the other stuff that has happened in India over the past few years, the reforms, the improvements in the functioning of policy making, et cetera, et cetera, et cetera. But at the end of the day, oil is a very, very important part of our economy and our macroeconomic fortunes, and that's essentially what's driving it. And if oil prices do head north, I think growth will be under pressure. That's the first thing. The second thing is that in the midst of it all, we've had, two disruptive policy, and whether you are in, whatever your views are about demonetizing GST, they have been disruptive, and consequently, in the largest post-GFC synchronized global lift, where every economy had benefited from the export lift that has taken place since middle of 2016, India hasn't benefited from it. So both these factors are at play, and if you throw into all of this, the concerns about trade wars, etc., they always affect sentiments, and in sentiment-wise, they affect investment decisions more than anything else. So if these are a variety of factors, but taken together, it doesn't really bode well for growth prospects in the next 6 to 9 months.
Okay, Jahangir, good speaking with you. Thanks much for all that perspective.